In a world where information just bombards us constantly, how do you cut through all that noise? How do you really understand what's going on with, say, financial currents or breakthrough innovations?
It feels like you need a secret roadmap sometimes, doesn't it? Just
Just
to keep up.
exactly. The sheer volume, it's just, well, overwhelming.
Right. But imagine if you could get that clarity, pinpoint the core insights, understand the so what behind the headlines, all without getting bogged down.
That's precisely our mission today on the Deep Dives. We're taking a really thorough look into the latest mid-year financial and product pipeline review from a major global healthcare leader, Abbott.
Yeah, and our source material for this, it comes straight from their detailed earnings call and the press release that went with it.
So our job really is to pull out the most important bits of knowledge, cut through the corporate speak, and show what's truly significant for you in your understanding of where healthcare might be heading.
hmm And the big picture, the initial takeaway, it's a picture of really strong underlying performance. They're not just weathering storms. They seem to be thriving, even with some pretty notable economic headwinds.
That's the interesting part, isn't it? How does a company manage that? So let's maybe unpack their financial pulse first, see how solid their footing actually is halfway through 2025.
Okay. It's actually quite impressive when you look at it. Their overall financial highlights, I mean, the numbers really speak volumes about their resilience.
hmm
They reported what they call high single-digit organic sales growth. Now, that's growth from their existing business, right? Excluding acquisitions and things.
Right, the core business.
Exactly. Specifically, it was 7.5% in the second quarter, if you take out the COVID testing numbers, and 7.9% for the whole first half of the year.
That is strong growth, especially given the environment. And it's not just top-line sales either, is it? We're talking double-digit growth in their adjusted diluted EPS.
Yeah. EPS, earnings per share, key profitability indicator.
Right. So for people maybe less familiar, they hit $1.26 in adjusted diluted EPS in Q2, which is an impressive, 11% jump year over year?
11%. And for the first half, it was $2.35. That's about 10.8% growth. So really consistent double-digit EPS growth.
And what about margins? That's always a key sign of operational health.
Absolutely crucial.
Yeah.
And they saw margin expansion, a 100 basis point increase in both adjusted gross margin and adjusted operating margin.
Okay, break that down. 100 basis points is?
It's a full percentage point. So gross margin hit 57.0% of sales. Operating margin climbed to 22.9%. It basically signals they're becoming more efficient, more profitable for every dollar they sell.
Okay, but like you said, headwinds. It hasn't exactly been smooth sailing, has it? They mentioned these transitory challenges. What exactly are these things making life tougher?
Yeah, you're absolutely right. The biggest, most immediate one is the drop in COVID-19 testing sales compared to last year.
Huge drop, I imagine.
Oh, yeah. To put numbers on it, Q2 this year, $55 million from COVID tests. Q2 last year, $102 million. And for the first half, it went from $306 million in 24 down to just $139 million this year.
That's a massive decline. But it sounds like COVID isn't the only thing, right? There were other challenges, too.
Precisely. Beyond COVID, they're also dealing with shifts in big markets, like China. They've got these new volume-based procurement programs, VBP.
Ah, VBP. That's the government pooling demand to drive down prices, right?
Exactly. And when you combine that VBP impact with the COVID testing decline, it adds up to a projected, get this, $700 million headwind just for their diagnostic sales growth in 2025.
$700 million.
And it gets bigger. If you also factor in changes in U.S. foreign aid funding for HIV testing, the total headwind is over $1 billion.
Over $1 billion in headwinds. That's staggering. So what gives them the confidence to, not just absorb that, but still forecast high single-digit growth and stick to their full-year EPS guidance? That's $5.10 to $5.20. Is there some secret sauce, or are these headwinds really as transitory as they say?
It really does speak to the underlying strength of their core business, and that diversified portfolio they have.
Right.
They also mentioned tariffs hitting them for just under $200 million. But interestingly, foreign exchange rates, FX, are actually helping offset some of that. So the hit to the bottom line, the EPS, isn't as bad as maybe it could have been. They're managing it.
So they're strategically absorbing these hits? What does this mean for their long-term view then? Are these just temporary bumps, or is this a new reality for them?
Well, they're clearly emphasizing that this current performance, even with the headwinds, fits right into their long-term goals. High single-digit growth, healthy margin expansion, double-digit EPS growth.
So they see a path back.
Yeah, the expectation is that these specific headwinds, especially COVID testing, China VBP, they'll ease up in 2026.
Hmm.
And that could potentially lead to an acceleration in growth down the line.
Okay. And if you're looking for like a concrete sign of stability, that commitment to shareholders,
Hmm.
you can't ignore their dividend history, can you?
No, that's quite something. 53 consecutive years of increasing their dividend.
Wow, think about that. In today's economy, that kind of sustained growth is pretty rare. Puts them right in that S&P 500 Dividend Aristocrats Index.
It's a really powerful testament to the strength of their diversified model. And that actually brings us nicely to the segment that seems to be right at the heart of their future growth,
Hmm.
medical devices. This is where the innovation is really driving things.
Okay, yeah, let's get into that. Because medical devices, that is their strongest segment, right?
Right.
Showing, what was it, 12.2% organic sales growth in Q2?
And 12.4% for the first half. Really robust performance.
And what's driving that?
It's coming from several key areas: diabetes care, heart failure, structural heart, electrophysiology, and cardiac rhythm management. And these aren't just small tweaks. Often they're like paradigm shifts in how patients are treated.
Let's start with diabetes care then, the Freestyle Libre. The scale of that success is just remarkable, isn't it? Nearly $1.9 billion in sales just for continuous glucose monitor CGM in one quarter.
Yeah, growing almost 20% organically. It's not just a product, it's really the category leader.
And what's really compelling, I thought, was their collaboration with Epic. That's the big electronic health record system.
Oh yeah, that's huge. It's a first of its kind thing. Direct integration of the Libre sensor data right into the EHR.
So for doctors and patients.
It just simplifies everything. Think about managing a chronic condition like diabetes at scale. This moves Abbott from just being a device maker into being like a vital part of the digital health ecosystem.
And they're not stopping there, are they? They're talking about this next level innovation, a dual analyte sensor. Measures glucose and ketones. What's the big deal with ketones? Why is that so significant?
Well, its main significance is in preventing diabetic ketoacidosis, DKA. That's a really dangerous, life-threatening complication where the body breaks down fat too quickly if there's not enough insulin.
Ah, right.
So this sensor could help prevent that. But also, potentially, it might let doctors prescribe a certain class of drugs, SGLT2s, for type 1 patients. Currently, there's a DKA risk there.
Interesting. So it opens up treatment options.
Potentially, yes. And they mentioned some early clinical data, I think, from the ADA conference, showing a high risk of elevated ketones if insulin delivery gets interrupted. So it really underscores why this continuous ketone monitoring is needed.
And Libre is performing well across different types of users, too.
Yeah, strong performance, whether people are on intensive insulin, just basal insulin, or even non-insulin users. Plus, the insurance coverage for those non-insulin users in the U.S., it's doubled in the last 3 years. It's around 30% now.
So that $10 billion revenue goal they have for Libre sounds like they're well on their way.
Seems like it. They also mentioned being ready for competitive bidding for CGM, feeling confident because they're a leader in scale and cost.
Right.
Oh, and there were some positive comments from the Secretary of HHS about how wearables like Libre can really help with behavior modification and just improving health overall.
Okay. So moving from diabetes to heart health solutions, electrophysiology, EP. That's growing double digits too. And they've launched this new Volt PFA catheter internationally.
Yeah, and they've finished enrollment for the key U.S. trial, the Tactiflex Duo trial.
So what makes this Volt catheter stand out? For patients, for doctors?
The benefits sound pretty substantial. They describe it as perfect for PVI, that's pulmonary vein isolation, a common procedure for atrial fibrillation, irregular heartbeats.
Okay.
This catheter gives real-time feedback on tissue contact. That's a big deal for precision. And what that means for the patient is typically fewer applications of the energy, less time under fluoroscopy x-rays, less muscle contraction. And it can even be suitable for procedures without general anesthesia.
Wow, that's a significant improvement. Patient comfort, safety.
Exactly. Now, in structural heart, their big goal is to be the leading global structural heart company. They want the full portfolio.
And they're making some big moves in the mitral valve space, right?
Yeah.
That's a huge area of need.
Huge. So MitraClip, that's their market leader for repairing the mitral valve. They're working on expanding its approved uses, its label, and they've launched a next-gen version. Better deployment, easier to deliver, makes the procedure smoother.
But what I found really fascinating was the FDA approval of their Tendyne mitral replacement valve.
Yes, that's a big step. It offers a new, minimally invasive option for people who aren't candidates for open heart surgery or even repair. Gives hope where maybe there wasn't much before.
And there's another one coming, a transfemoral one.
Mm-hmm. Even more exciting, maybe. They're developing this new transfemoral mitral valve replacement. It came from an acquisition back in 2019, got FDA breakthrough designation.
Which means the FDA sees its potential.
Right, and they're targeting a pivotal trial for it next year. This is huge because it addresses mitral regurgitation, which is the world's most common heart valve disease. Millions of people affected.
Incredible potential impact. What about TVR? That's aortic valve replacement.
Right, transcatheter aortic valve replacement. Their product there is Navitor. Sales have actually doubled in the past 2 years.
Doubled. Why such growth?
A lot of it is international success. Plus, they benefited from a competitor exiting the market in Europe, creating an opportunity. And they're expecting CE mark approval soon for a label expansion into lower-risk patients in Europe.
And in the U.S.?
In the U.S., the plan is to double the size of their team to get Navitor into more hospitals. Right now, they're only in about 20% of the centers that do TAVR, so lots of room to grow.
That's a clear roadmap. Okay, what about cardiac rhythm management, CRM, pacemakers and such?
Yeah, CRM saw 10% growth, and that's largely driven by Avatar, their innovative leadless pacemaker.
Leadless meaning no wires going into the heart.
Exactly. It's this tiny device implanted directly in the heart. It's fundamentally changed the growth path for their whole CRM business, made pacemakers much less invasive.
They're innovating on a DevAir too.
Oh, yeah. They just finished a feasibility study, the first ever, looking at using a leadless pacemaker for something called conduction system pacing.
Conduction system pacing, what's that?
It's a way of pacing that tries to mimic the heart's natural electrical rhythm much more closely than traditional pacing, more physiologic.
It's interesting.
Yeah, and a pivotal trial for that is targeted for next year. Plus, they're working on a next-gen Avair with a 25% longer battery life.
Always improving. Okay, quickly, heart failure.
Heart failure saw 14% growth. That's driven by their ventricular assist devices, VADs, which help pump blood for very sick patients, and also CardioMEMS.
CardioMEMS, that's the implantable sensor.
Right. It monitors pressure in the pulmonary artery, giving doctors early warning of worsening heart failure so they can adjust treatment proactively.
And briefly, vascular and neuromodulation. Any highlights there?
Yeah, growth drivers there include things like advanced vascular imaging tools, products for closing up vessel punctures after procedures, their Esprit bioresorbable stent, and the Eterna spinal cord stimulation device for chronic pain. Lots going on across the board.
Okay, so we've covered the really impressive financials, considering the headwinds and these groundbreaking medical device innovations. But let's broaden out again. What about the other divisions, their strengths, their focus? Let's start with nutrition.
Right. Nutrition, the main growth driver there is clearly adult nutrition. Saw 6.6% organic growth in Q2.
What's behind that demand?
It led by their big brands, Ensure and Glucerna. You've got consumers increasingly looking for complete, balanced nutrition, protein-rich diets for healthy aging, and also specialized products for managing diabetes. It really taps into those big demographic and health trends.
Makes sense. Then there's established pharmaceuticals, EPD. That showed strong 8% organic growth in what they call their key 15 markets. What makes those markets so attractive for branded generic medicines?
Well, these markets, places like India, China, other parts of Asia, Latin America, the Middle East, they benefit from really favorable long-term trends. Think healthcare access improving, economic growth, demographic shifts like higher birth rates in some places, expanding middle classes, aging populations.
So growing demand for accessible healthcare.
Exactly. Growing demand for quality, accessible medicines. It's a smart long-term play for branded generics, which offer that quality assurance.
And they're building a biosimilars portfolio too, right? How does that fit in?
That's right, and it's a very strategic move. They've already completed 10 regulatory submissions, planning launches starting in 2026.
What's the strategy there?
It lets them leverage the infrastructure they already have in these key emerging markets to bring in more affordable versions of cutting-edge biologic medicines.
Ah, so drugs for things like autoimmune disease.
Right. Autoimmune, women's health, oncology, even the new GLP-1s for diabetes and weight loss. They can bring these advanced therapies to regions that maybe haven't had much access before. It's about expanding access and, of course, market share.
Okay. Now let's loop back to diagnostics. That's the segment that's been facing those headwinds we discussed. It saw that 1.4% organic decline in Q2, but you said there's a strong underlying current there.
Absolutely. While the overall segment number was down because of the big drop in COVID testing and those China VBP impacts, Their actual core lab diagnostics business, that grew 8% if you exclude China.
8%. So the base business is healthy.
Very healthy, strong performance in the US, Europe, Latin America. And their main lab platform, the Alinity system, continues to perform really well. It shows there's robust demand for their non-COVID diagnostic solutions.
So connecting this to the bigger picture, it sounds like despite these current, maybe temporary issues, Abbott is still very bullish on diagnostics long term.
That's precisely it. They see diagnostics as just fundamentally important and non-negotiable part of the healthcare system globally. These current challenges, they view them as transitory. They're very confident in the long-term outlook for this business.
Makes sense. Okay, stepping back even further, beyond the individual divisions,
Yeah.
what are some of Abbott's broader strategic priorities looking ahead? Maybe start with their approach to M&A, acquisitions.
Yeah, their M&A approach seems highly selective. They're focusing mainly on diagnostics and medical devices, which makes sense given where the growth is.
And what are they looking for in a deal?
They emphasized finding opportunities that are strategically fitting, but crucially, that generate an attractive return. So they're prioritizing profitability, return on invested capital, not just buying revenue for the sake of top-line growth.
And having a strong internal pipeline helps there.
Exactly. Because their organic pipeline is so strong, they can afford to be more picky, more disciplined about the acquisitions they do pursue. It's a smart position to be in.
Okay. They also talked about tariff mitigation. That was having, what, nearly a $200 million impact. That's significant. How are they dealing with that?
It's a big challenge. They mentioned having 6 different work streams going on, basically leveraging their huge global manufacturing footprint, 90 sites, to try and navigate the impact. It sounds complex.
And they're building a new plant.
Yeah, they also plan to build a new cardiovascular manufacturing site right here in the U.S., aiming for 2028. So that's not just about managing current tariffs. It's a strategic move, medium and long term, for supply chain resilience, local production.
Got it. And finally, the infant formula litigation, obviously a sensitive topic. What's the company's stance there, and what's the sort of overall impact?
Well, the company's position is that they stand firmly behind their product, its safety record, and the support it gets from doctors, regulators, the scientific community.
And the business impact.
They emphasize that this specific product line is actually a small part of their total revenue. Their main point seems to be that decisions about care for the most vulnerable infants, those should be made by physicians, by neonatologists, based on the science and the individual patient's needs.
Okay. So as we kind of wrap up this deep dive then, the picture that emerges is, well, it's one of incredibly resilient performance, wouldn't you say?
Definitely. Despite facing really substantial headwinds, that diversified model they have, plus the very strong product pipeline, it's clearly driving growth. They're absorbing challenges and strategically setting the stage for, potentially significant future growth.
Yeah, it really highlights how a company that's well-positioned, highly innovative, can actually absorb these big market shocks and just keep advancing its mission, which is ultimately about improving health around the world.
That's the core takeaway.
So thinking about all this, the relentless pace of innovation we just discussed, Abbott's strategic approach in both established markets and emerging ones. What new frontiers do you think might be the most transformative in healthcare in the next few years? And maybe how might those developments impact patients globally? Something to think about.